As the new year unfolds, diversification benefits of small cap and international stocks, along with REITs, continues to ring true. But some of these same markets are facing increased volatility and risk. So what can advisors and investors do to overcome these obstacles? We'll tell you about several ETFs with a hands-on approach that can solve some of the problems facing investors. Paul Baiocchi with SS&C ALPS Advisors joins us right after this. Welcome to the program. I'm Thalia Hayden. It's great to see you again. Be sure to subscribe to ETF Guide TV and post your thoughts in our comments section below. We have Paul Baiocchi with SS&C ALPS Advisors joining us right now. Paul, welcome back. Great to see you again.
Nice to see you as well, Thalia.
Yes, you look great. And moving to the first question, the past few years have been a lot more volatile and shakier than many bond fund investors expected. Some are even questioning the traditional bond indexing strategy. The Smith Core Plus Bond ETF is among your firm's latest ETF launches. Can you tell us more about the fund's approach and how it might solve the problems facing fixed income investors?
Sure. This is a product we're extremely excited about, largely because it's our first foray into the core fixed income segment. Of course, we've got an actively managed municipal bond ETF that goes alongside SMTH. But what SMTH is a product that we launched in partnership with Smith Capital Investors. And Smith Capital Investors is a firm run by Gibson Smith, who was CIO at Janus for a long period of time. He's got 30 years experience in fixed income markets, managing portfolios on the institutional sales side, knows the ins and outs of managing bond portfolios in a way that very few people do. And it was about 5 or 6 years ago that we launched a mutual fund suite with SCI. And we've grown that complex to north of $3.5 billion in AUM across a number of products, most of the assets, I should say, are in their core strategy. But what the ETF launch allows us to do is offer his IP, his portfolio management approach to investors with the flexibility that the ETF wrapper affords. And the approach that Gibson and his team have always provided in the fixed income space is typical bond portfolio management. It's not esoteric products. It's not derivatives. It's what you expect from a fixed income manager in your core fixed income allocation. And so when investors think about how they're allocating to fixed income in a market environment that, as you pointed out, has been so challenging and so volatile over the course of the past couple of years due to a number of factors, Fed policy and the like, it means that in theory, as you go forward, the environment isn't necessarily going to get easier just because the Fed is likely to cut here in 2024. It's going to continue to be a very challenging market backdrop. And so what ALPS always tries to do is partner with best-in-class managers. And that's what we believe Gibson and his team provide in the fixed income market. So as ALPS, we now have an ETF that is relevant to 40% of your typical asset allocation if you're thinking about a 60-40 split between equities and bonds, and do so with a manager that has provided really strong performance in a category that is so critical to so many investor portfolios.
Smart approach. Now, 2023 was a tough year for the U.S. office market. In fact, the Wall Street Journal recently reported the trend is likely to continue. And now more than ever, it's important for real estate investors to be extremely selective about what they own. And rather than taking an own everything approach, as many index funds do, the ALPS Active REIT ETF uses a radically different strategy. Can you tell us about that?
Sure. So I think a lot of people see the headlines about commercial real estate and they look through these empty office buildings and they think REITs must be representing that difficulty and the debt-mageddon, as people call it, as it relates to the refinancing on some of these underwater properties in that commercial real estate segment. But if you look at REITs in the S&P 500, for example, those under the hood of XLRE, the Select Sector SPDR real estate ETF, a lot of that portfolio is in things like cell tower REITs and diversified REITs, specialty REITs, and data center REITs, segments of the market that aren't really necessarily exposed to a lot of those segments in the commercial real estate market that people have such big concerns about. Now, that's the passive approach to the market. But what REIT does is it leverages experience from the GSI team, which was spun out of Green Street, one of the foremost authorities on real estate research on Wall Street, and allows them to leverage that expertise, leverage that experience to go and pick individual sectors, to go and pick individual REITs, do that analytical, value-oriented research on individual companies, make sector tilts, make individual company tilts relative to the benchmark. The performance of REIT relative to its benchmarks has been really strong since inception, and we're about to cross the 3-year anniversary of the launch of REIT. And so for investors who typically do have, say, a 5% or some carve out toward real estate and REITs in their portfolio, what REIT does is provide an extra layer of expertise in a market that we do think will have winners and losers. And being indexed in this segment of the market can be problematic depending on what economic dynamics are undermining certain segments of that market. So we feel very strongly that REIT is a really compelling way for investors and advisors alike who have a carve out for real estate to tap into, like I mentioned with Gibson Smith and his team, best in class managers in a segment of the market where they can, from our perspective, add a tremendous amount of value through the research, through that rigorous investment process that they apply in the ETF wrapper and the flexibility that comes with it.
Sounds like a good strategy. Now, a recent article in Barron's noted that nearly 50% of the companies within the Russell 2000 small cap index are unprofitable. Small cap stocks are still an attractive long-term asset, but an active hands-on approach might be warranted here. And that's where a fund like the Alps shares US small cap quality dividend ETF comes in. How does the fund work and what does it own?
Well, I think you hit the nail on the head in terms of how many companies in the Russell 2000 are unprofitable and how, in many ways, the past 10 years or so of interest rate policy and interest rate markets have allowed companies to subsist without generating profitability because borrowing was easy to come by and, importantly, it was relatively cheap. That's not necessarily going to be the environment we operate in over the course of the next 10 years. So we feel strongly that it's important to take that universe, and in the case of OUSM, not just small caps, but small and mid caps, and cull that universe down toward companies that have higher profitability. We measure ROA in the index methodology, have less leverage. Net debt to EBITDA is the factor that they use. And then not only pay dividends, but are growing their dividends and have dividends that are well covered. In addition to all of that, have low volatility relative to their peers. So we talk a lot about active versus passive, and we mentioned SMTH, an actively managed fixed income strategy. We talked about REIT, an actively managed REIT strategy. OUSM is sort of in between the two extremes. It doesn't follow your typical cap-weighted view of the market, whether that's the Russell 2000, the S&P 600, or the S&P 400. What it does is it takes a lot of the characteristics that an active manager might deploy in this universe and simply does it in a rules-based systematic way. So it isn't an active strategy in the sense that there's no manager with discretion, but it's certainly not the far end of the other side of the spectrum in the sense that it's a passive strategy. So it's a quality dividend growth strategy in a market where we think that's really important. And I'll point out that if you look at the valuation gap based on a trailing or forward PE basis between small and mid-cap stocks and their large cap counterparts, it's as wide as it's been dating back to the dot-com bubble. So in many ways, there is a valuation case for being in small caps. There's also a portfolio construction case, a diversification case, but we feel strongly that you can't just be naively cap weighted in that segment of the market because of those economic dynamics, namely the impact of higher interest rates on unprofitable companies, tighter lending standards impacting those businesses. And so if you can focus exclusively on companies in this universe that are not only able to generate strong profitability on their asset base, but are able to do so without excess leverage, have a dividend that is well supported by fundamentals, i.e. dividend coverage, and are also growing their dividends, that can, and historically has since the fund was launched, provided shallower drawdowns. And when you're trying to compound returns over time, drawdown avoidance is one of the most important things that investors can focus on.
Great information, Paul. One final question before you go. In 2023, the Alps International Sector Dividend Dogs ETF delivered strong results, even outperforming difficult to beat benchmarks like the MSCI EFA index. Why do you think IDOGs is so successful, and why should investors not be so quick to abandon international stocks?
Well, the second part of that question is interesting because typically the cycle of US versus international stocks, US outperformance, international stock outperformance, vice versa, tends to play out over, say, 10-year periods. We're going on 16 years of US outperformance of their international counterparts as measured by EFA or developed ex-US. And so a lot of investors have just sort of thrown up their hands on ex-US portfolios, and that home country bias was already problematic for a lot of advisors and for a lot of investors. So we do think that ex-US, developed ex-US in particular, is an important diversification tool in a portfolio. And when you look at the valuation between ex-US and US markets, large caps or otherwise, there tends to be a significant discount in the valuation of those ex-US markets. But if you look at EFA or you look at your cap-weighted view of those markets, akin to what we were talking about in that small and mid-cap space, you tend to have a lot of exposure to financials. European financials aren't necessarily a segment of the market that has a very constructive outlook. So what IDOG does, similar to what SDOG does domestically, is it gives you more balanced sector exposure in that marketplace, while of course, as the name would imply, focusing on the dogs, companies with high yield at reconstitution. So you are taking a universe that does tilt value relative to the US, tilting it even more cyclical value, while at the same time providing exposure to some of the sectors that EFA is underweight on a relative basis. And on a go-forward basis, we think that balanced approach from a sector perspective, that cyclical value bias that IDOG has relative to its benchmark, provides investors with a diversification tool that can be really valuable in the market environment over the course of the next 10 years.
Great stuff, Paul. Thank you so much for your insights. Unfortunately, we are out of time. Keep up the good work, though.
Thank you so much, Thalia. Always nice to see you.
Great to see you, too. And be sure to visit alpsfunds.com to learn more about the ETF lineup at SS&C ALPS Advisors. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.